Hey, good morning, traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. I am your host, Bennett Tyndall. Thank you guys for taking time out of your busy Wednesday mornings to join us. It is September 28th. My goodness, time flies. As you can see, bottom left-hand corner of your screen, index futures are moving higher this morning following news out of the Bank of England. We'll get to that with Alex and the team in just a few minutes. Again, S&P 500 continues to move lower following the wave count that we have been tracking with you all. Yesterday, we finally printed new lows in the S&P 500 for the year, although the market continues to behave in a bit of an interesting manner. We'll take a look at the charts in just a few minutes. Before we get to the charts, let's go ahead and welcome in the team this morning, including company founder Todd Gordon and Director of Investments for New Age Wealth Advisors. Good morning, gentlemen. What's up? How are you doing today?
Hey guys, how's it going? Good morning.
Welcome. Good morning.
Hey guys.
Good morning, everybody.
Terry, Alex, what's up?
Another beautiful
Got a
day in
hurricane
Texas.
hitting Florida.
Yeah. I have a buddy of mine who just took a new job. They're building a house and supposed to move to Tampa today. So needless to say, he's pushing it back.
That's a challenge.
I hope everyone's okay, but wow. It's Cat 4 making landfall right about now, I guess. I hope everyone's okay in Florida.
Yeah, definitely. It's quite an interesting, it's been a challenging past couple of years, so thoughts are with everybody in Florida today. If anybody's tuning in from Florida, hope you guys are safe. Hope you guys are safe.
Yankees clinched the AL East. Aaron Judge still looking for 61 home runs. Everything's fine there. But anyways, there's more important things to talk about.
In the crazy world of financial markets, huh? So what do you guys think about Alex? Do you guys want to get into the news now, or should I take them through the charts first?
Yes, set them up to the charts. And then I really wanted to, Alex and I have, we first met when we were trading the FX markets long time ago, over 10 years ago. And Alex and I have a lot of foreign exchange, and there's a lot obviously happening with interest rates, and those interest rate differentials is what drives foreign exchange markets. And following the global financial crisis, all central banks around the world went to zero interest rates, and obviously that's changing now. So we're getting some interest rate differential, which is creating FX moves. So this is the kind of stock market where you have true intermarket analysis, the four major asset classes: equities, fixed income, equities, commodities, fixed income. And what am I leaving out? I was up till 1 a.m. trying to figure out what's going on in the world last night. Anyways, you know what I'm saying? They're all moving together, and it's important that you understand how it all works. And this move out of the Bank of England was super interesting, buying bonds, suppressing interest rates, where central banks all around the world are trying to hike rates to control inflation and try to stem off this U.S. dollar strength, which is generally bad for the global economy. So I just want to get into that with Alex, but Bennett, take it at the top and show us what's going on as we keep our normal flow.
All right, sounds good. Let's take them through the indexes, and I'll catch you guys in just a couple of minutes. All right, good morning once again, and thank you again for joining us. Let's hit it hard right edge of the trading analysis edition of the MotiveWave platform. We're going to first look at price action in the S&P 500, and my goodness, I do apologize for the a bit of a background noise in the camera there. You guys can see some behind the scenes of what goes on the production side as I clean that up there for you. All right, so let's hit it. Taking a look first, and we're going to take you quickly through the indexes. We have been kind of reiterating our higher degree wave count view over the past few weeks, so I felt it would be more appropriate to just focus in on everything that's occurred from the June lows into the August highs, and then where we are today. So the two preferred ways that I look at the S&P and the NASDAQ suggests, and it continues to suggest, that this is simply a corrective environment, as opposed to the idea that we truly have motive or trend establishing moves off of the all-time highs in the indexes. Now, in the event we see acceleration, we won't discount that possibility, but signs are most certainly still in favor of this being simply a, not garden variety correction, but a overall corrective wave that should result in a buyable low and a move to new all-time highs. So zooming in on the view that you see here in front of you, and this view, although complex, is really just 3 Elliott wave corrections to the downside that are separated by 2 Elliott wave corrections to the upside. And in this case, you see those counter trend corrections occurring in both of the X wave positions. We knew going into August that that would be the decision month where markets had the opportunity to either secure the June lows by maintaining price action above 39.45 in the S&P, or we knew in the event we broke south of 39.45, that would invalidate the traditional impulse wave and suggest a move to 36.36, aka the June 17th low was upon us. So looking at this particular wave count, we are now trading into new lows. We successfully broke south of 36.36 yesterday. However, we're not seeing the signs in the price action and in the behavior of the markets that would cause me to believe that this is, in fact, a big higher degree third wave bear market, such as many in the Elliott wave community have led you to believe. So we're a bit more optimistic here at Trading Analysis, and we do feel that a series of new lows should be the completion of this correction. So looking at this interpretation, the WXYXZ triple complex combination correction is a bit unusual. I've shown you examples in individual stocks. However, we have never really seen a true example of this printed in the major US market indexes. I think this is the first instance where it's actually going to be the case, and we have kind of attributed that to the fact that we have been in a complex environment. So the WXYXZ, the dreaded triple combination correction, it's very simple in that now that we have the move under 39.45, we are looking for essentially the trend from August to complete in 3 waves. And the way I see this is our initial actionary wave or motive wave down in the A wave position to September 6th gave us a nice 3-wave retracement into the 10th, 11th. We get a move down. We break south of this short-term uptrend line support. And now what we're looking to see is 5 smaller waves in the wave C position. And within the wave C position, we can actually count waves 1, 2, 3, and possibly even 4 complete. What this would suggest is that we simply have one final subdivision to complete, targeting a downside low near 3,500 to 3,450. Now, what's really interesting about this zone, and I find it quite fascinating, is if we take into consideration the magnitude of the initial wave off of the August 16th high, we measure that, we project it from our B wave, 161% of that decline takes us to 3464.99 in the S&P. What's interesting about that level is, number one, that takes us to the lower boundary of this corrective trend channel, and corrections will often be contained within parallel trend lines. Therefore, we would love to see that zone of support, fib, and trend line support hold for the end of the correction. So that's one sign we need to be monitoring for. But in addition to the lower boundary of the corrective trend channel, we also have, notice this 1272 fib level at 3469.36. All that is simply an external retracement of the summer rally. So as we were pulling back off of the August 16th high, as I'm sure many of you did, drawing a retracement of that move, you'll notice the 618 acted as support. We break through the 786. We didn't even pause at the 786. We get to the 100% retracement at 36.36, aka the June 17th low. And now the 1272 external retracement, which is often met when you break through the 786, takes us right to the 1618 of C versus A. So what that tells me as an Elliottician is to expect at a minimum 3464 to 3500 as a stopping point in the index. Now, if this view is in fact true, from there we should begin an impulsive journey higher. Whereas alternatively, if in fact the correction this year has been just simply an ABC where we have a 5-wave diagonal down into June, 3 waves back into August, the only difference between the wave count I showed you and this wave count is this wave count would imply the move needs to complete as a 5-wave trend. So instead of this being down in A, up in B, looking for down in C to complete, this would say that the series of lows and support near 3450 to 3500 should be a temporary stopping point. We get a wave 4, and then worst case scenario for me currently, I'm looking 3250 in the S&P. Why is 3250 of interest? Glad you asked. Over to the weekly time frame, we can see here, if we take into consideration the magnitude of the 2022 decline, January through the June lows. We measure that, we project it from the August high. A 100% relationship, so equality of the magnitude of that initial decline, would come in at 32.6452. What's fascinating about that particular fib level is it also has confluence with a 50% overall retracement of the post-COVID low rally. So March 20 through January of 22, 50% takes you right to the 100% C versus A relationship. That also happens to be more or less, as you can see here, in the vicinity of other swing waves of significance. We had right here into 3250 swing wave high in June. So there's some levels of interest there and some former swing waves, both high and low, that would correspond with that zone. So I do continue to look lower. However, I do expect it to be a longer term entry opportunity. So again, 3460, 3500, stopping zone number 1. That should at least deliver wave 4, or that proves to be the end of the correction. So that's it from me this morning. Let's jump back over to the trading analysis team. What do you guys think? Triple combination or just a simple ABC?
I mean, that triple combination, man, that's like PhD level LIQUIDITY stuff.
I love it.
A lot of people have a hard time understanding this whole WXY concept, but then when you throw a WXYXZ at them, they turn off their television sets and say, I'm going to go do something else.
But you're so right on that point. And what I like to, or the way I like to explain it with clients in our courses, in which we've got a launch coming up here, is, in the basic sense of Elliott wave, we've got 5-wave moves and we've got 3-wave moves. We know there are 3 major corrective patterns, and the way we've, you have also taught it here at Trading Analysis is, looking at the combination is simply just that, a combination of those various Elliott corrections. But it can be a bit confusing, which is why I felt it would be good to break it down in either a 5 or 3 completion.
Yeah, and that's all it is just real simple. We got a lot to talk about, but if it's W, X, Y, X, the X is, just think of the X as a connector, and then the W is one of the 3 Elliott wave corrections. There's only 3 Elliott wave corrections. There's a flat, a zigzag, and a triangle. So it's one of the 3 corrections connected via an X wave to a move that needs to buy more price and time. It's too shallow. It's too immature. So X wave connects, and then we're going to go into another complete Elliott wave correction, flat, zigzag, triangle. Right. In triangles, there's places where you look for a triangle to occur, but the concept is there. So it's Elliott wave correction connected to Elliott wave correction connected to Elliott wave correction. And that seems to be what's happening. And that 1272 is interesting. And, one of the things that, am I sharing screen or no?
Yep. I'm sending it your direction right now. Take it away. Oh, there we go. All yours.
Okay. Oh, thanks. And this is leading into Alex. I really want to talk to him about what's going on with the Bank of England putting a little short-term quantitative easing and sending the markets into a tizzy. Not a tizzy. It's the markets are acting so shell-shocked and so just confused. There was no conviction one way or the other yesterday. The VIX finally got the courage to get up above 30, and then that was quickly pushed back. It's just the market, like I said, this on a macro perspective, I think is so confused in here. And everyone's saying, well, let's figure out what's going to happen in the future. And guys, I'm running longer term portfolios. I'm going to make some adjustments today and tomorrow. But right now, I really think the future is not written. I don't think you can know, what is going to happen here in the next week or two. It's just, we could be down 10%. We could be up 15%. We could be sideways. It's crazy. I hate to say it, but long enough in the markets, you have to have the confidence to say, look, I don't think there's an edge from my point of view. You just have to be properly positioned. And hopefully you're okay in either situation, which I know that's a big reach, but it's tough in here. It's a very confused market. And I'll tell you what, guys, it's not your job and to figure it out. And I think that's my advice to the trade analysis team is, I don't know if it can be figured out right now. I think you have to watch to see how things unfold and then move accordingly. But anyway, so leading into that what I want to ask Alex, I think this euro chart is interesting. Obviously, the dollar strengthening is dropping the euro, and the euro is right at the 786 retracement. And we talked about that. And that's one of my favorite retracements and extensions. And the heart of it is just this. So you have 0.618, which is your golden, actually 0.618, which is the inverse of your golden ratio. But you understand. If you take the square root, which didn't there used to be, oh, there you go. There's a square root right there. The square root of 0.618 is 786. So what that means, and a lot of good relationships we find, and I'm going to tie that back into Bennett's point there, is if a move does not hold the 61.8, which everyone and their grandmother knows that fib ratio. If 61.8 doesn't hold, a lot of times they'll run stops and get down to the 786. And, we've seen some really good reversals that happen at the 786. Now, the other one that Bennett mentioned, the 1272 in the S&P, this is just a quick math class for you here, but it's a really good relationship. 1.272. It's not really working correctly. But anyways, I'll work on that. I don't know what the heck's going on with that one. A move that, so as I said, 618, you take the square root of that, 786, and then the golden ratio, 1.618, so the 161.8%, if you take a square root of that, that's, oh boy, I'm having a hard time this morning. Square root should be the 1272. So all of that whole story, what that means is and we find a lot of times a move that does not hold the 786 often goes down to the 1272 extension, which is down here. So I'd be curious to see what Alex thinks. I think he's got a differing view because I think the dollar's up into resistance. But, if the euro does not, oh, here we go. I see what I'm doing. If the euro does not hold that, I would not expect the double bottom to hold. And then you've got to target the 1272. And then, as you said, the S&P is down here already at, coming up into support, wherever it is. I think it's 100 S&P points lower, but it's pending. So just keep that in mind. And this ties into the direction of the market. If the dollar does stop rallying, the euro stops selling off, that could be an interesting reversal point going into what Bennett was saying. And then, if you look at pound, I can't believe the pound is at 106 right now. I mean, Alex and I are trading FX back here when it's $1.70, $1.80. So we've come a long, long way. So this dollar strength is certainly playing into the weakness in the market. And just to give you sort of a short-term view of what happened, so this is just a little 5-minute overlay, and I'm kind of going back to my day trading days 20 years ago because that's just the kind of market we're in. So I've got 3 charts overlaid here. In white is the 30-year bond futures, and it's important to look, our bond futures to see what they're doing in response to what the Bank of England just did. So the initial move with the Bank of England buying bonds is for our Treasury market, 30-year bond to rally, sold off a little bit, and then is rallying even more sharply. So that's interesting. I mean, are we going to start buying bonds again and do a little quantitative easing? I don't think so. But the sterling rallied up and then sold off and then has come back and sort of where it was pre-announcement. And you can see on the S&P futures here in purple, that kind of put a bid in the market. We have futures just around unchanged here early into the session. So it's really important if you are trading in here, trying to get a feel and handicap what's going on, got to watch the currency markets, fixed income, commodity, and equity markets, and just watch those relationships. And there are places on the internet to get the real-time data if you don't have access to the futures. But definitely jump in there. Thinkorswim is great. They give you the futures data. But watch where that dollar goes. Watch where our bond market goes. And it's crazy. So can we bring Alex in and just, Alex, give us your take, being our macro specialist, like what are they doing with a temporary bond purchase program?
Okay, so first, it has been 15 years that you and I made into contact.
Oh, don't tell me that. Is it 15? Oh,
it was actually 2007 when I think sent you my first chart when I labeled impulsive move with the ABCs and corrective move with the impulse wave. I still have this chart somewhere. So okay, guys. So just
15-year friendship, two trips to Serbia, which was awesome. Thank you for being with me this long.
Yeah, still I have to come to USA. Don't forget that. Okay.
Oh,
Listen, guys. Okay, so a couple of things. First, situation with the US dollar. We all know that interest rate differential play one of the key roles. Secondly, we have a Bank of Japan with a yield curve at 0.25, creating a massive amount of carry trade from Japan to US. And thirdly, we have also emerging countries and companies in the offshore and the onshore dollar markets, which are indebted in dollars. So dollar going higher more than and above 120 will bring havoc to the world. So I expect either increased swap lines from Fed, or I expect some accord, joint central banks interventions. Dollar higher is not good for anybody, and it's starting to make a really trouble everywhere. Look, Korean won, which has depreciated, I think, 31% or something. So Asian currencies are going bust. So that's the first thing. Second thing, we talked about the liquidity in the system. So as the liquidity is drawn out, I think the central banks of England, which actually cut on the plan to raise taxes because they think their economy is already in recession, has encountered some of the liquidity problems in the system. And they warned in the last 2 days, kind of a verbal warning to markets, but markets didn't stop, pushing bonds lower and yields higher. And then finally they're intervening because I think they have a credit freeze into the system and they need to clog that up with some of the liquidity additional add. Will that be temporary? So this is the first sign of the global liquidity problem, which starting to kind of mess through the system because you need to refinance all of that debt that exists. So I think we are now seeing a first signs that actually this is making a big clog into some systems in regards of a credit flow. So I think, as I read, I think they want to ease off these credit problems, which finally they recognize into a system and makes the flows a bit more available to square up to some of the debt problems they have into the system.
So they're injecting liquidity into the system to alleviate a credit crunch, but what they're doing is they're suppressing bond yields by pushing up bond prices, which increases the interest rate differentials, which makes their currency weaker. Which doesn't that accelerate the issue? I mean, with a weaker currency, doesn't that accelerate credit concerns?
Yeah, they did two stuff. They lifted rates to 225 and then announced probably 1% move higher on the next meeting. So they're balancing what you're saying with the interest rates on the upside and pushing the liquidity into the system to alleviate some of the credit problems, which they didn't set which credit problems they are. So as the pound went down on a tax cuts, because the plan was to raise taxes around 25%, and on the various things they're cutting now taxes and most of the other stuff to kind of a boost economy. They're increasing interest rates to actually strengthen the pound, and on the other hand, they're increasing temporary liquidity to kind of a funnel this liquidity into the system. So they're doing two things in the same time.
Are they of different durations? Are they adjusting the shape of the yield curve? Are they moving? Obviously, the Bank of England is moving the short-term rates, and maybe they're no. I mean, this is actually. So I mean, there must be moving along, and they're doing this in gilts, which is their 10-year, maturity. So they must be adjusting the shape of the yield curve.
Probably temporarily, just 30 years. I think they're acting on 30-year durations. So most likely they have some credit issues, and by pushing the pound, trying to push the pound up with the interest rates, they think they're going to do this temporarily just to ease off some credit, but they didn't announce what is the problem into the system. That's why we don't know actual cause why they're doing that.
And that's the question too, is like, was this coordinated? Did they announce this to the rest of the central banks and mainly the Fed? or was this a surprise move that central banks didn't know
No,
about?
they already warned, kind of a verbal warning in the last 2 days, but today they acted. So
Okay.
actually, everybody was knowing in advance something like that might happen. And also, you have last week Bank of Japan intervening on the FX markets to kind of warn, as you know, interest rate differentials on the carry trade are actually, if you do that, you need to hedge the currency exposure because you can lose all your interest rate differential if the currency sweeps on the other side.
And that was there was some confusion on that Bank of Japan move because you and I traded through central bank intervention, which never works. Even coordinated central bank intervention, which during the global financial crisis, you and I were trading FX, like you'd have all the major central banks trying to move in on an agreed upon currency defense, and that didn't work. So this is their first, that's called coordinated central bank intervention. And this is the first time they did unilateral intervention. So the Bank of Japan tried to take on the whole FX market, which, no, good luck on that.
Yeah, as you know, I think it's kind of a narrative for the new entries, because now we are trading 145, 150 on dollar yen. So what they're doing, actually, they're warning, kind of send warnings. If you want to do this more, we are here. So be careful. So I think it's just the narrative for the new entries. If you want to continue and enter on a new round of carry trades, they're kind of a warning new entries.
Good point.
Be careful.
Good point.
If you put this down, you might lose your gains. So I think
that's a good point. I don't want to lose our listeners here, but as I said, this is so important to have somewhat of an idea of what's going on and being able to watch those two markets right now, or watch fixed income, watch currencies, because they are impacting what's going on in the stock market. So try to read up on what's going on. But Alex, that's a good point you make. And I mean, we're going back now over a decade. You're right. When Bank of Japan used to intervene, they would buy dollar yen, because what was happening during the global financial crisis, the opposite problem was happening. The world global money managers were selling yen, shorting it at 0.5% and then investing in Australian bonds at 5%. That's called the carry trade. Well, when the housing crisis started, the rest of the world started covering their yen shorts, sending it back to Japan. The yen was very strong. I was day trading on Wall Street, literally dollar yen, euro yen over a 1-minute S&P futures chart. It was freaking wild. Now the opposite's happening. But your point, Bank of Japan would step in to stop yen strength, spike up the market real quick, shake those carry trades out. It would settle back in. But your point's a good one. They're just trying to kind of warning shots, you're not going to.
Exactly.
That's a good point.
We are on the macro side on a very dangerous cocktail, because we have the global system, which is clogged with debt. There is 350 trillion, which is basically refinanced. So we are adding more debt, and now the liquidity from the system gets pulled off. So this is the first time that we have seen that one of the major central banks are actually reversing. Actually, they didn't still start, but they postponed the start of the QT and actually introduced temporarily QE. But for me, that's a first sign of a crack. It's not a catastrophe, but we can just say this is just the first small signs that there is some cracks in the liquidity system, which is completely normal when you see rates going so suddenly on the upside with this global liquidity, which needs to be refinanced and added, So I think this is just the first crack. They're going to feel it. What will happen afterwards? We will see. It depends how central banks are going to push rates. Actually, I have a list I'm going to show you afterwards. There is only one bank with negative rates, and that's the Bank of Japan. Even Swiss National Bank is now in positive rates.
Let's bring the team back in, Bennett. I don't want to do a show.
No, you're good.
Why don't we ask the audience? Why don't we ask our listeners? Do you guys want to focus in? Where do you guys want to go? Do you want to get into what's going on overseas this morning, or do you want to kind of focus in on what we're seeing in domestic markets right now? I don't know. Why don't you want to kind of let the viewers tell us where they want to go, or how do you want to run it, Bennett?
Yeah, I'm totally open to that. Let's see if we get some feedback here. Alex, we passed you the screen as well if you wanted to grab it and
Sure.
cover any.
Okay.
While we're waiting on the viewers, I got a question, and maybe you answered it and I just didn't hear it. How is what the Bank of England doing different than what the Bank of Japan did last week?
Yeah, a bond buying program in Japan is already 20 years old. So Bank of England is now actually injecting liquidity. Why? While the Central Bank of Japan is acting on a currency front. It's completely two different asset classes. So
well, they're not completely different. They're very much related in here.
They're connected. They're interrelated. But you can act on one or another. In that sense, they're different.
Last week, So last week we saw the Bank of Japan do their thing, and we saw the U.S. stock market just collapse because of that, because we saw 10-year yields rise. But today we're seeing the opposite effect when the Bank of England's doing their thing. So I'm a bit confused.
Well, Terry, hold on. Let me just start with Bank of Japan and just throw this in front of you. And I hear a lot of people saying this dollar buying is a safety trade. People are going into the safety. It's a reserve currency. No, the dollar's the new carry trade, because you can borrow in the rest of the world at nothing, make 4% in a couple months in the U.S. Like, that's a ridiculous carry trade. So the Bank of Japan is saying, I don't know, maybe it's a coordinated attempt to stop the interest rate differential, selling of local currencies, selling of foreign currencies to buy dollar to create a carry trade, because they know how that's going to wind up when that comes off. It's not good. So it's like, right? I mean, that's one of the major things, the unwind of the yen carry trade that exacerbated the global financial crisis. S&P futures, dollar yen coming off, euro yen coming off with that 1 minute correlation. So it was the carry trade putting on and the unwinding of it that helped push S&P futures down. That was one of the key things spurred from the housing bubble. Bank of England is doing the other thing, buying bonds to inject liquidity in the system, pushing rates lower, which increases the spread between UK yields and US yields, which this is why I'm a little confused, is which that only encourages more of a yen carry trade, of a carry trade. But I understand what you're saying, Alex. You're trying to inject liquidity in the system to solve certain short-term funding issues, but longer term, I don't know how that helps.
I think it's a short term, and they said it's a short term because Bank of England is now at 225 with the rates. So as I'm saying, they're doing just a small balancing. In my opinion, we're gonna see how they're gonna go with the time, but they're at 225. Okay. Europe is at 125 still, and in ECB. Right. So as you see, this interest rate differential equals or came closer to Fed, then dollar has to eventually start moving lower. So as you know, this game of interest rate differential and liquidity are intermixed in the world. And since we are in the world where we have injected liquidity and 0% rate for a long time, now when you see interest rate differential coming again into the game, it makes a very speedy havoc and things are going fast. So I think market still didn't digest this, in my opinion, but I think it will fall into a proper place very soon when the interest rate differential came closer to the Fed rates. And you have a point with euro. I think we are around 0.92 to 0.95, which is around your support levels for a reversal. That's my case scenario.
So are you buying into that euro support, dollar resistance? I mean, don't you have dollar resistance a little bit higher in the dollar index?
First dollar index resistance is at 112.50 to 114.50, and the other secondary one is 118.42. There is two of them.
Bennett, you make the. Do you want to send the screen to Alex and just continue because we're so deep into this
Alex,
conversation?
If you want to throw your charts up.
Yeah, I don't think you see my screen.
Yep, I do. I see your
do.
VMix call. I see your VMix call. Yep.
Okay, do you see my screen now?
Yep, take it away.
Okay, so this is first all of the major world banks' interest rates currently. So as you can see,
can you zoom in on that?
Mm-hmm.
Zoom. Yeah, there you go. Perfect.
Okay, so we have 3.25 in United States. Australia is 235. Chile 10.75. South Korea 2.5. Brazil 13.75. Great Britain 225 from 175. So Canada 325. China 365. Czech Republic 7%. Denmark 0.8. Still very low. Europe 125, Hungary 13%, India 5.4, Indonesia 6.5, Israel 2.
We got it.
Yeah, Japan is the only one which is still in negative. Okay, so all of the rest, New Zealand already at 3%, Norway 225. So as you can scroll, even Switzerland came into from minus 75 into 0.5, which is a positive territory now. So what do you have? You have, when interest rates rise, as you know, Todd, even available liquidity flocks into the banks for deposits, which is, of course, can alleviate some of the liquidity crisis, but I think it's not enough. So we have a pretty dangerous cocktail, I think, there. And as you know, market is trying to price in and find the balance, and I don't think we are at that balance yet. So let me just go with
hold on, to put you on the spot. Do you know where inflation levels are domestically in Switzerland and Japan? Because those guys have negative nominal rates. Do you know offhand where they're reporting inflation?
Yeah, I didn't look. I think Japan is around 0.5 or 0.75 or a little bit above it. And for the Swiss, I didn't check. I have to check it. I didn't check.
UK yields, you said, are 2.25 right now?
Yeah, 225.
Longer. Okay. I love it. I'm telling you, like, I love, this is important that we have an idea of what's going on, but I'm sorry, Alex, I don't miss the FX. I used to trade for an FX hedge fund. Like, I don't miss it. I'm sorry. I don't miss it at all. I just love being in the stock market.
Yeah, as you know, I mean, the volatility is okay, but this sudden volatility nobody likes. We like it as a traders, but in general for the world is definitely not good, because after 20 years of almost with small intermediary pauses, we are at almost 0% rates, and now you have a 1 year when world walks havoc and the debt is much bigger in the world. So that's a kind of a tough thing to balance with this geopolitics. So I think it's a pretty dangerous cocktail, and I think central banks will have a hard time. And I think it's already cooking something, how to actually increase liquidity and kind of make rates. At some point, they will have to stop. Otherwise, some major things will break.
Yeah, but let's not get too sensationalistic. Like, look, Europe crisis, we all lived through that. The peripheral debt crisis. It seems to be Europe liquidity is okay. London, England, obviously we have a lot of stuff going on there with the energy crisis. I would venture to say that, I know it's a significantly large economy, but I would say the UK influence on the rest of the world, I would say, is waning or is not as important as Europe. And Japan, the same thing's been going on in Japan. They still have zero interest rates because they've been suffering demographic deflation. So it's like, is any, like, I don't want to get too, I mean, do you think this spreads? Do you think this kind of starts a contagion sort of situation, or do you think this can stay isolated?
I think for now it's isolated, at least in this moment, but it's a warning sign. At least I'm looking at it like that. It's a first small crack, and I need it to be monitored very carefully.
Okay. All right. Fair enough. Jump in. Tell us take us where you want to go.
Okay, guys. So let me just quickly go on rates. Bennett and I has been going back and forth with the charts of US 10-year yields. So there is a couple of things from the Elliott wave perspective. So this can be some type of a wave 3. 1618 is the usual destination of the fee projection that we have for the wave 3. It's a little bit debatable that we put a triangle here. This is still a viable option, but I think some of the fib ratios doesn't match. Maybe that's okay for rates, but I think with the current situation and the Fed actually going on rates, I think we're going to get a pause and the one more move on the upside. So I think it's more appropriate to actually structure this chart that we are in the wave 3 on the upside, which is actually agrees now a little bit more with European rates. So European rates, German 10-year Bund spiked above 2.326 this morning. So obviously we are in the intermediary wave 3 target, maybe a little bit more on the upside, or here I expect also correction. So I think with this thing that we are seeing in the system, we might get a little bit of a pause, which kind of also agrees potentially to what we have talking about yesterday with the probable triangle I'm just trying to kind of paint the picture. This is just a hypothesis. And we might see a pause in this rate if this continues into the system. But as you can see, Lagarde was very clear yesterday. They're going to hike rates for the several next meetings, which I think it's going to come about 2.25 to 250 in the European world, which actually tells us that after a small pause, we're going to see a higher rate. So these two charts are clearly suggesting we are very close to pause and a continuation up when this 5 waves up actually fulfill its purpose, or an impulsive wave on the upside. So dollar index is bumping into my resistance, but a smaller time frame wave count doesn't justify still this as a wave 5. We have only 3 waves up, which I think we need to have a 5 in a 5th wave. So I will allow a little bit overshoot of this 5th wave, but generally I think it is very clear from my perspective, and also I think Bennett agrees, that this is just a 5th wave on the upside, and we will see in the next months, next couple of months, clearly with the interest rate differential equaling with the Fed or coming closer, that the dollar might get lower, which will alleviate some of the problems that we are facing now, and I think that will be very good for everybody. I don't think dollar will go to 120. My final target, if this becomes a little bit kind of exaggerated on the upside, will be 118.42. That's closer to 120. Yeah, we can make that notion, but I think we are very close and we are in the last sequence. We just need to see this smaller 5 waves up unfolding here and actually completing this cycle. So if we see on a commodity front, our Thomson Reuters index is functioning pretty nicely to the downside. We have flagged this a way back before, that we are expecting commodity prices to go lower, and we are seeing that on many fronts, which I think on the end we'll be seeing in the CPI. Next CPI is on 13th of October, so I think that's a very important date. Also, we have a next Fed meeting on 21st of November. So this will be a pretty, I think, lower reading in the CPI as I see these things comes off. As we also see the oil charts and the net gas charts, they are going lower as well. Oil is trading, this is Brent, 86.89. So this chart still functions well. In this regard, I don't think we are at the end. I don't think this is a double top or a failed 5th. I think this is just a wave 1 on the upside, and we are tracing down in some wave 2 to the downside. In oil markets, also the net gas are making a bigger push lower. So I think still we are in some type of a wave 4 before seasonal things kicks in. We can also go from here, but 1618 is holding nicely. So there is a very nice Elliott wave pattern here which kind of explains that we are either in a 1-2 in a fifth wave or in a fourth wave. I think that will be seen very soon, but I do see higher prices in the next couple of months, at least in US, in the gas space. If we also see soybean very corrective, I expect to move down, already started a little bit. And also the wheat prices with the last, although the news was from Russia, we have a record harvest in Russia, 150 million tons, I think. So it will go through the world markets through China because of the sanctions, but nevertheless, I think the wheat prices are much lower than it were before. So on all of these fronts, we are seeing lower prices in commodities, which will have, I think, their take in inflation. Although you have seen services in US going up, and I think it's because of the job-related issues in the US, but I don't think that's sustainable. I think commodity prices will have a take on that, and we will see lower inflation in October as well. So let me just go through gold and silver. Gold and silver are moving, I think, lower. Let me just find these charts and show you that, and then I'm going to finish quickly. So gold is trading at 1644. We are still in this ending diagonal pattern, in my opinion. So weekly 200 moving average is there. Around RSI comes on weekly level around 30, which is one of the lowest points in the last 5 or 6 years. So I think we are very close to reversal point here in gold. So this needs to be watched. And silver, we always emphasize for our viewers, it's very important to have a confirming price action. Don't pick up the low, guys. We didn't see 5 waves up on silver, so we might see a little bit more downside in silver prices. So that's all from me, guys. Back to you.
Very good. Much appreciated, Alex. All right, passing the screen your direction. Let me know when you've got that up.
Good.
All right. Take it away.
That's really good, Alex. Thanks. And, I just want to, really, I know there's a lot of deep macro stuff happening right now, but just keep it all in perspective. I'm going to be real quick and just show you guys these two charts just to kind of show you. Sorry, I've got so much up on my screen right now. Just kind of keep in perspective what's going on in the U.S. markets, bringing it back. Such a simple chart here. So much going on. There's a lot to talk about at the news. CNBC is going to be all over it because Delivering Alpha is in New York City. I was supposed to go down there today, but I canceled it. I emailed them at 1 a.m. last night. I was like, I've got to stay here. There's going to be a lot of talk about the macro as we have, but it's important to just step back. And sometimes, I just remind people, just step back and look at a blank long-term chart, and let's just get basic and get some context of what's happening. This is SPY with volume. Okay, this is 2008 credit crisis. Look at the volume that was flowing through the system in 08 and 09. Look at what's happened here. This is a log percent change, right? Look at the scale of the move compared to 08, and look at the lack of volume in the SPY, which is reflective of total volume. It's non-existent. There is no volume out there. It's crazy. If you go down to the weekly, this is even more mind-blowing to me. You look at the volume was strongest when we were going into the high. This is the weekly, and then we're starting to drop here in the SPY. The volume, except for the last couple of weeks, is starting to pick up just as we've got this little move. But net, the moving average of volume is down. So what does that mean? There's a couple things that are keeping me up at night, literally. If you go over to this one, so this is the investor sentiment here. Where is it? I had it right here. If you look at investor sentiment, it's been terrible. And a lot of people jumped all over the this data point, which the AAII, so American Association Investor something, is good. The recent print came out at a 61% bearish reading. This chart didn't update yet from wide charts, but the new one's going to print up here at 60.1, which, is close to the global financial crisis bearish sentiment reading when we almost lost the economy. So people are bearish, people are talking bearish, but then if you go down here to total stock allocation and cash allocation, this really hasn't moved very much towards the lows. We're still at a 64% stock allocation. People are scared and talking about it, but they're not doing anything. And that sort of resembles the lack of volume that we saw in the SPY and the downturn here. People aren't capitulating. People aren't dumping the position. You look at the cash. All right, we're at 21% cash, which is, not quite where we were in 2020 and nowhere near where we were back here in 03, 04 and 7, 8, and 9 going into the global financial crisis. So, you look at the downturns again in the S&P here, and the gray areas are recessions. The cash allocation is nowhere near where you should be, 40, 50%. And the stock allocations are nowhere near where they've been in prior significant declines, even though this feels like something that's similar to 2008, as evidenced by the investor sentiment up there. So I think it's important to keep it all in perspective and say, okay, people aren't dumping their positions. We saw there was a big report out last week that institutional and retail put buying was at record highs. So maybe everyone's hedged. I do that with, some of my clients who are in the financial position to do that, do downside put structures, and you don't have to sell the position. So maybe people are already hedged. Maybe that's why the VIX really can't get above 30. Or, and you say, okay, the sentiment is very bearish, and then, perhaps we're going to work to get max bearishness and then begin to work into a low, as Bennett was mentioning and Alex was mentioning at the top. Or do we still have that big capitulation to come, and people do need to offload their stock positions before we can reach a meaningful low? That's the question that's on the table for me right now. And I think it's hard to answer right now, as I said, but this is something that I'm watching quickly. Guys, I'll turn it back over to you, wherever you want to take it from here.
Very good. Appreciate it. Excellent data there. And it's a good visual to help put things into perspective, especially with the volume chart. I was taking a look at that yesterday after we were discussing it in our company Slack. And it is certainly not what one would anticipate if this were truly the more significant fifth wave top that some still believe it is.
Yeah, very valid point.
Right.
All right. Mr. Long, sir, you ready to rock? Take us through Optima. Take a look at some rotations.
Let's see if we can nail this through here in 15 minutes.
Oh, you got it. All right, man. Take it away.
You got it.
We'll be back on the other side to wrap up.
Yeah, great discussion, guys. You basically took most of my intro points away, but I'll go ahead and read them anyway. So hello, traders and investors. I'm Terry Long at tradinganalysis.com with your weekly sector focus. So last week, the Fed announced what supposedly the markets were anticipating, a 75 basis point rate hike. But apparently overly hawkish comments must have been the interpretation as the market sold off hard the remainder of the week. Now, additionally, the Bank of Japan attempted to shore up the yen by selling U.S. treasuries, which drove yields higher and added to the market's move lower. And now, this morning, the Bank of England injecting liquidity into their currency. All right, this market data here is for the week ending September 23rd, with Monday and Tuesday's data points showing here. The S&P last week declined 4.65% for the week. I'm missing my marker there, but that's what we saw there. The index almost exactly the same, down 4.64%. And I find that interesting because we usually see the index move with a higher beta ratio, right? So look back here, when we made a gain 2 weeks ago, S&P gained 3.65, the index was up 4.05. And the prior week, index S&P was down 4.77 and index was down higher, right? So that's the beta effect. Now this week here, these two numbers are almost identical. Now, last week, All 11 sectors were closing sharply lower. The week's worst performing sector was the energy sector. It's got walloped 10%. Crude oil fell sub $80 a barrel, a level not seen since January before the Russia-Ukraine conflict began. Now, looking at the sectors that outperformed the S&P, even though they declined, we have the staples. It was the most resilient, though it did decline 2.73%. Utilities, healthcare, and yes, even the technology sector here all held higher than the S&P's decline. So let's fast forward here to what's happening Monday and Tuesday this week. I'll bring this little table over here showing you that we have 10 of the 11 sectors down on Monday and Tuesday's price action, with a little bit of a positive action here in the consumer discretionary. And you believe it or not, consumer discretionary up 0.34% in 2 days of trading plus 15 minutes here. The worst performing sectors this week is utilities and the real estate sectors, both of those almost down 4%. All right, let's move over here to our relative strength sector leader scoreboard. Oh, I got one more thing I want to point out, because I did mention this about last week. This is about price action here in these 2 days of trading. The S&P was down 1.24% going into this morning's open, but the index was only down 0.35%. Now, that may seem insignificant to you, but the index is demonstrating some outperformance of the benchmark S&P each time this happens. One more thing, I do want to say that the S&P undercut the June lows just barely, but the index is still yet to penetrate that level, so time will tell. All right, so over here in our sector leader scoreboard, the rotation is showing the utility sector remains in first place with a relative strength score of 104.3, and you've got a northeasterly tilt coming back into utilities with today's price action. In second place, we still have the consumer discretionary sector continuing to add relative strength gains. It does move further into the leading quadrant, but it is seeing a little bit of a momentum decline. Now, the energy sector holds on to the third place, but with that huge 10% loss last week, I don't know how it continued to move higher, but at the moment it still is showing a improving vector. Now, the industrial sector last week made its way into the leading quadrant, but with a very hesitant push. See how short the vector is compared to this massive momentum thrust in the energy sector. Industrials is just quietly pushing itself up here into the leading quadrant. Now, the technology sector also is showing a weakening trend, and it has been dropping. We've seen a decay. It is still technically outperforming the S&P, but it is in a state of decay. Now, the staples sector last week was the most resilient, and it does indicate some rising momentum, as there's a new hook forming here in both the staples and the healthcare. Healthcare also outperformed the benchmark last week, and it's also got a little bit more signs of momentum gain. All of these stocks that are to the right of this vertical line are these ETFs, these sectors, are outperforming the benchmark S&P, and anything to the left is in an underperforming state. Now, it's interesting to note that despite a 6% loss last week, the financial sector had formed a rising blue improving weekly price trend and a northeasterly heading, gaining both relative strength and momentum as it pushes through the improving quadrant. At price action this week, if I flip over to now, this last vector represents the 2 days of price action that we've had Monday and Tuesday. So the last line segment is incomplete. We need to get through Friday to complete it. But you can see the very short tail length here in financials indicates to me there's a pause happening of that forward momentum and relative strength gains. Now, the real estate sector was really hard hit last week, down 7.16% and shedding another 4% or so this week as it does continue a southwesterly track. The materials sector fell 6.13% last week and is down another 1.5% this week. And the communications sector lost nearly 6% last week, and it's down another 1.69% this week. So these sectors and most of the stocks in these sectors are continuing to underperform. So since we're just about out of time, I'm going to leave it there and not go into any more detail. Thank you.
Very good. Much appreciated, Terry. Thank you for taking us through that. Viewers, appreciate you sticking with us through the open here. Members, we'll see you in about 8 minutes for our weekly member webinar. If you guys did enjoy the content, please subscribe with notifications. Give it a thumbs up. Drop a comment. It's a great way to help support the Trading Analysis team. And you can, of course, visit us anytime at tradinganalysis.com. We'll be back live tomorrow for Alex's Crypto Lab, 9 a.m. Eastern. Anything else, gentlemen, before we let him get out of here?
Good.
Yeah,
good session, guys. Good.
I would just like to mention there is one guy called Russell Napier. He reiterated 1 year ago the situation where actually we might see some changes in the ratio that institutions hold bonds. So as a solution to this, he actually mentioned a potential financial repression where the big institution will be forced to buy more bonds and actually hold this balance between the bonds and real interest rates. We are still not there, but there is also some of the possibilities which might happen as well. And this dollar situation, if it is alleviated, that might bring a balance. So let's see. I mean, but it's interesting thesis. Very interesting one.
You can explain that one to us later, Alex.
Okay.
All right, we appreciate it. Thank you, guys. Excellent work as always, team. And we'll be back same time, same place next week.
Okay, see you guys.
You guys have a good one. See you next week. Take care.